entitled Value Creation for Sustainable Real Estate. Siqi Zheng will be moderating, and she has assembled an extraordinary group of panelists to delve into this topic. Siqi is the Samuel Tak Lee Champion Professor of Urban and Real Estate Sustainability at the Center for Real Estate and the Department of Urban Studies and Planning at MIT. In addition, she serves as the faculty director for the Center for Real Estate. Academic research already shows us that sustainable real estate not only enjoys a significant value premium, but also shows more robust and less volatile financial performance during a time of uncertainty. In this panel, we will discuss the multiple value creation pathways of sustainable real estate and also explore various sustainable investment and value creation opportunities for a wide range of real estate portfolios. And with no further ado, I give you Siqi Zheng.
Thank you, Denise. And thank you so much for everyone, all of you that stayed to the last panel. And I also want to highlight our panel is the only one all-female panel. I think that's very good when we talk about ESG, and then we also talk about gender topic yesterday, Roberto. So we have this final all-female panel. And then it's my great honor to have our three panelists. I'm going to briefly introduce our panelists. So Jennifer here is a managing director of climate change and sustainability service at EY. And Jennifer, she leads engagements focused on sustainability and environment, social and governance, basically ESG strategies, reporting on climate change with clients across a range of industries, including real estate, hospitality, and construction. And before EY, Jennifer is a VP of Corporate Responsibility for CBRE, the largest commercial real estate service and investment firm. And before CBRE, she also worked with Prologis for many, many years. So that's Jennifer. And today, Jennifer will mainly talk about this regulatory environment of sustainable real estate. So later, she will tell us a little bit more about this ICEC rule and the local law 97 and the carrots and sticks for the sustainable real estate. And then I will introduce Sunita. Sunita is Managing Director, Sustainable Investment at CDPQ, Ivanhoé, Cambridge. And so basically a very, very top leader driving the high performance in the global commercial real estate for sustainable impact through innovation and talent. Anna is Chief Operating Officer at Veris Residential. Veris Residential is a REITs company and specializes in multifamily properties. And Anna is part of the leadership team supporting its vision to create communities with purpose. So I also want to talk a little bit why we organize this panel like in this way. Of course, just now we already mentioned this is basically the heat wave
Amber alert.
alert, which shows how important we need to address the climate change issue. Right? And then, yes, how we organize this panel, basically we know Jennifer from EY, and Jennifer works with a lot of clients from the consultancy, from the service, and for this sustainability with a purpose. And then we have Sunita from CDPQ, Ivanhoé, Cambridge. That's a pension fund, the second largest or the first largest pension fund in Quebec province in Canada. And then we have Anna from REITs. So we have pension fund and REITs, one on the private market or on the public market, and both with a long-term view because you hold assets for a long time. But I also noticed from Anna, your LinkedIn, that you also worked in some private equity real estate companies before this. So it's very interesting to compare private equity and the REITs and the pension fund because you have different time horizon and how you consider sustainability. So that's the point. And also I want to mention that both EY and the Veris Residential are our center's partners and support us so much in our research and also our master's program, especially for the climate and real estate research agenda. So at the very early stage, when we started to do this climate research, at very early stage, we didn't have data, we didn't have very clear idea. I really appreciate EY's support at that time and help us to identify the real research questions that have meaningful implications in the industry and also work together to do the research. And I also very appreciate Veris, and then you share with us your valuable data. Because if no data, then we couldn't really produce any meaningful research results. And Veris share with us all these residential multifamily buildings in New York City and in Boston and New Jersey so that we can run our energy model and financial model. Finally, I'm very grateful to Sunita. This is a story of myself. And many of you know that as a professor, after 6 years of very hard work, teaching and its research, we can get a semester off as a sabbatical leave. And then this past semester, I was on sabbatical leave. And then I really, after being a professor for 18 years in a row, I feel so bored. Yes, I never had experience to work in a company, a business world. After my PhD, I just became a professor, and then 18 years. Then I said, I must go to a company to try. Then I just, how can I get an internship? And I submit my CVs to many places and interviewed. Finally, I got the offer from Sunita and from CDPQ, Ivanhoé, Cambridge. I feel so grateful that I also love the city. So basically, now I feel like at first I was 100% professor. Maybe now I'm a 75% professor plus 25% practitioner. And I really learned so much from how to connect the research and the practice. Sometimes the professors too rigid and too unrealistic. How to translate what we from the research that really the investment team and the asset management team can really use. So I'm very grateful for all you three that I learned by myself and also our team as MIT Center for Real Estate. Okay, I talked too much, but without further ado, I will just hand over to Jennifer for you. Three of you, each of you will have 6 minutes for a very short presentation, and then I have questions here.
Great. Thank you so much, Siqi, and hi, everyone. So great to be here for this last panel of the conference. It's been an amazing event. As Siqi mentioned, I'm going to talk a little bit about the regulatory landscape, and specifically, I wanted to talk about the SEC's climate disclosure rule. So as you may be aware, the Securities and Exchange Commission proposed a rule on climate-related disclosures 2 years ago in March of 2022. They finalized that rule just in March of this year, March of 2024. And things that were included in that rule that would be required for publicly traded companies here in the US to disclose include things like their climate-related risks and how they are identifying, assessing, and managing those risks, what types of governance they have over those risks. So is there board oversight of the risks? How is the management team involved in managing those risks? Perhaps greenhouse gas emissions, depending on the type of organization, and if those emissions are material to the organization. We'll talk about materiality, what that means in a second. But a lot of things were included in that rule, right? And so I wanted to talk a little bit about some of the things that our real estate clients are specifically concerned about. And before I go any further, I should mention, and you probably are aware if you've been following this at all, that this rule is under a voluntary stay right now. Immediately after the rule was issued, it was promptly, the SEC was promptly sued by many parties. Some parties who said that the rule went too far, or said that the SEC did not have authority to be issuing such a rule, that it would be too burdensome to companies. So while this process plays out in the courts, we still don't know when that will be finalized, when that will all be sorted out. It will probably be a matter of months yet. But it could possibly be sorted out before the end of this year. And again, we still have no idea what the result will be. But I think one of the things we like to tell our clients is that hope is not a strategy. So don't hope that it's going to go away. Don't hope that it's going to be altered. It certainly could be. But the best thing to do is to prepare now, especially for companies who are considered to be large accelerated filers, because they would be subject to their first disclosures for their fiscal year that begins in 2025. So if your fiscal year aligns with calendar year, and this rule ends up staying as is, you could be collecting data as soon as January 1st for disclosure in 2026. So again, just wanted to make sure everybody kind of had that background information about the rule. Happy to talk in more detail now or at a separate time if folks want to get into that any further. But again, wanted to talk about kind of two specific items that our real estate clients are interested in learning more about and are concerned about. The first one is an interesting thing in the rule that is not in any of these other ESG or sustainability regulations that you may be following that requires companies to disclose expenses and costs associated with severe weather events and natural conditions. What the heck is a severe weather event and natural condition, you ask? Well, in the rule, there are some illustrative examples listed, such as hurricanes, tornadoes, floods, droughts. These types of things could be considered to be severe weather events and natural conditions. The registrant, the company doing the disclosing, doesn't actually have to determine whether these events were caused by climate change, but they do have to, again, collect information about costs and also recoveries associated with these different events. The SEC said, we don't want to be too prescriptive here, right? Depending on an organization and the geographies where they operate, their historical context, that these things could potentially be impactful to one organization or maybe not another. And so for a real estate company, a lot of these things could be very relevant to your organization. And so what we're really advising clients to do now is to really draft a memo to identify how are you going to define what these severe weather events and natural conditions are. Because again, if you are subject to disclosure, because of this rule, you will need to, disclose this information in a consistent and meaningful way. This will go into your audited financial statements. Your auditor is going to wonder how you decided which of these items actually were material to your organization, how you collected that data. So again, if this is something you're subject to and you're not paying attention, please definitely start to look into this and start to draft, your definitions for severe weather event and natural condition as it applies to you. The other thing that our clients are really trying to, make some sense of is this definition of materiality. So the SEC's climate disclosure rule uses the definition of materiality that is the traditional definition defined by the Supreme Court, right? An item is material if there's a substantial likelihood that a reasonable investor would consider it to be important when making, decisions about your organization. And so the reason this is important is in many, many different places throughout the rule itself, you will be subject to disclose things if they're material to your organization. So again, how are you and your organization specifically are going to define, what is material to you? So you could be, again, subject to disclosing, material climate risks, anything that materially affects the business or your operations, scope 1 and 2 emissions, or again, your operational greenhouse gas emissions, only if they're material to your organization and if you're a large accelerated or an accelerated filer, right? Some of these other things that go in your audited financials as well. And this is just a fraction of the things that are tagged with this word material. So again, really encouraging our clients to think about what does material mean to your organization in this context, and again, drafting an accounting policy memo and really having that as your guidance so you can point to that, right, when you're developing these disclosures so that you can feel very confident in what you're disclosing and why you're disclosing it. So again, I know that's not even a fraction of the things that we could talk about as it relates to the SEC rule, but wanted to, again, highlight those two items as things that some of our real estate clients are especially concerned about. And again, I would encourage you all to start thinking about now, while you have the time to put thought into it.
Thank you so much, Jennifer. And then Sunita.
Okay, how does this work? Just hit this? Okay, great. Thanks, Siqi. Thank you so much, and it's really nice to be here. Thanks, Denise. It's great to meet you as well, and it's just really an honor, and it's been such an interesting year already. So I'm going to talk a little bit about La Caisse des Dépôts de Placement de Québec, so that's CDPQ. This is the second largest pension fund in Canada, so it's a pretty big player when it comes to investing. I've been with the company under the real estate sector called Ivanhoé Cambridge. So Ivanhoé Cambridge recently was integrated into CDPQ. So we are no longer a standalone company, but we are the real estate division of the pension fund. So That's an important nuance because I'm not going to speak about all of the pension fund activities. I'll focus on real estate. So I've been with the company 16 years. A little bit of me, I started as an attorney. I moved into HR for a few years, and today I work in sustainability. So it's been an interesting journey. The lens is getting wider and wider. And Siqi also joined us in October last year, and she spoke at a sustainability summit that we hosted with 70 of our global partners. So I'm grateful for you. You came in and you really, and your work today also is great. Siqi is working with our investment teams, our asset management teams, really with boots on the ground, trying to find solutions, and we're going to talk a little bit about that throughout the presentation. So a little bit about the Caisse de dépôt. So like I said, it's the second largest pension fund. They have about 434 billion Canadian dollars in assets, and we have 9 offices around the world. So we really are global. We invest in real estate, of course. So constructive capital is how we speak about our capital and want to do better or do good. We also invest in private equity markets, private credit, infrastructure, and really again focused on real estate. That is myself and my team. And then as far as the purpose, and it's aligned with the purpose of Ivanhoé Cambridge, we invest this money for 6 million Quebecers. So our purpose is to generate returns for these retirees and also to create economic development for Quebec around the world. So when we invest, example, we have a project that we did in Denver. It's a timber project. The timber came from Quebec to Denver. So we try to bridge those gaps and try to create opportunity for companies, local companies in Quebec. And then Ivanhoé Cambridge, we have about $77 billion as of last year in assets in real estate. So the largest portion of our portfolio is in the U.S. It's the biggest, I guess, real estate portion of the portfolio. It's quite big. It's quite significant. I don't know if Donnell's still in the room, but we're going to have to talk about your statement about LL97 because that's giving me a little bit of heartburn. I was texting Rob, who you met. I think you guys did some work for us on Stonehenge. So anyways, but in terms of sustainability, and I'm sorry, I should have been flipping through these slides, which I didn't. But in terms of sustainability, again, we do believe in creating long-term value. We believe in investing constructive capital towards the environment, towards social initiatives, and obviously all wrapped around a strong governance structure. We look at sustainability in terms of risk-return levers. That's how we look at it. So how we invest, these are factors that are considered in the underwriting of an investment. So whether it's from a risk standpoint or from a value creation or return standpoint, that's how we look at sustainability. So these are some of the priorities in terms of la Caisse de dépôt overall. So the mothership, as I call it, but I'm part of the mothership now, so it's a bit weird. Anyhow, so we have our environmental pillars, our social pillars, and our governance pillars. So as you can see, we really are trying to come up with concrete solutions and how to create this long-term value for our pensioners. And then more focused on the real estate side of things, these are some examples of some of our highlights from last year. So in terms of the pathway to net zero, in terms of what we actually have decarbonized thus far, in terms of sustainability-linked loans, which I'll talk a little bit about as well. In terms of our social obligations, there's a lot more here, but these are just highlights. We did certify our headquarters well equity. We're one of the first adopters in Canada of that certification. We truly believe, in walking the talk. It's not, it's easier said than done, I think, but we do believe that. And another really big belief of ours is that we're not going to get there alone. Going back to the presentation previously is, which parts of the world are more mature, which parts of the world have, the strongest conviction in terms of sustainability. And of course, there's all kinds of extreme positions, but the reality is we're not going alone. And whether we are aligned or not aligned, we feel a responsibility to bring people along with us. So whether you're a smaller player or a larger partner, we do look at that in terms of who we invest with and where they are in terms of their journey, in terms of sustainability, and we will try to bring them along, giving them tools, giving them playbooks to try to get them aligned in terms of that value creation and that risk mitigation. I think that's probably it from an intro standpoint. Thanks, Siqi.
Thank you.
Pass it to you, Anna.
Yeah, Anna.
Thank you. Thank you, everyone. Thank you for being here. And I'm going to speak about Veris Residential today. We're a multifamily REIT listed on the New York Stock Exchange of around 7,500 units in the Northeast. And as a company, we went through a pretty big transformation over the last 3 years. Looking now nearly 4 years back, we were predominantly an office company with, I want to say, zero interest in ESG. And we've turned that fully around, starting with reconstitution of our board back in 2020. And one of the first things our new board and new leadership wanted to do is to make sure that ESG and sustainability is fully integrated in everything we do. When we rebranded to Veris from what was previously McCallie, the listed entity, it was a key part of the brand and is really a lens throughout today how we see our decisions and act in every day and every side of our business. You see some of the key stats here. 80% of our properties these days are green certified. Our whole portfolio is well health and safety rated and well equity rated. And we really try to make sure that on the E and the S and the G, we implement best practices and do what we can for our residents, our employees, and all of our stakeholders. So now how do we approach all of this? When I was looking at this slide yesterday, what I found really interesting is how much it resonated with what has been said yesterday and throughout the conference about many of us balancing, on one side, being a real estate company, a REIT with public shareholders, fiduciary obligations, and really needing to generate returns for our investors, with wanting to do what's best for our people, for residents, for employees, for our communities, and then being cognizant of the environment and our impact of it. And we summarize this approach in different words, but it's kind of the same principle, and it's properties, people, and the planet. We're very focused on building communities with purpose, and I'll give you some examples in a bit, making sure our employees are well looked after, that they work in an environment that's diverse, supports them in any way we can, and that we do what we can for the environment to reduce our carbon footprint and make sure our impact on the environment is as positive as possible. The other way to look at it is from a stakeholder lens. We have shareholders, we have residents, we have employees, as I mentioned. But what I want to spend a minute on is what I like to think about is really our differentiator factor. And that's thinking of ESG as an amenity. We are in the multifamily space, and if you think about being a resident, someone who rents, you really have very limited impact on how sustainable your environment often is. It's not like you can put a thermostat in your room. The landlord has to be motivated to do that. You can't really focus on your air quality and many other features of your home. So for us, it's very important for us to give our residents the tools to live a more sustainable life. And here are some of the examples. And we do all of this in a way that does not compromise returns, that actually, if anything, generates net operating income and returns for our shareholders, and is beneficial to the bigger mission of the company. The example I like the most to talk about is the hydroponics farm. You can see the picture in the top left there. We have these now in 3 of our Jersey City properties. It's vertical farming, right on site, fully organic, no pesticides, nothing like that. And we grow fresh produce that once a week the residents can come down and collect free of charge. And while they do that, they can spend time with the gardeners planting. Maybe kids can join in or whole families can come in. They can interact with fellow residents. We can do events. And we're that way producing not only an environmental benefit to the community, but also a social one. It's a place for gathering. It's another amenity for the residents. And we funded many of these by ancillary income, other opportunities on the revenue side, reducing the payback periods and really ticking a lot of the boxes from the pure return on investment and investor side. Some of the other items you see here are things like EV chargers. or beehives, which we now have at 15 of our properties. We are having our first honey this year across the board, and some products. Again, like residents can come in a few times a year, speak to the beekeeper, learn about the process, and get educated on what bees mean and pollination to the environment around us. And it's not only big things, often it's small things. It's changing our residents' behaviors, and again, giving them the tools to do that. And composting is a great example of that. In a residential building, how on earth do you compost? Well, we give you the bin when you move in. And then it's just a habit. You form the habit of your food scraps going in the bin and you dropping it off downstairs. And bit by bit, we change these little behaviors that help us achieve our bigger sustainability goals and collectively make us move in the right direction. Thank you.
Okay, good. So now I'm going to take this advantage as a moderator to first ask some questions. So basically, as a 75% professor or 80% professor, I really know my responsibility is to teach our students. So that's what. So I'm teaching this sustainable real estate class here at MIT Center for Real Estate, our master's program. So all students need to take my class, and then when I teach sustainable real estate, always there's some questions from the students. Say, okay, you always say sustainability is good, and it will be also financial performance also good. This alignment. But we feel it's a propaganda. So we just want to say something good, right? And so that can justify that you need to study this and you need to take my class. You're from China, you're very good at propaganda. So I said, okay, I must get rid of this propaganda to make things real. To really look into the real market, the market incentives, and then how we can really convince and justify to students that there's a way to align financial performance and ESG. So now I'm gonna ask you questions, and I will take notes, and later when I teach, I will pretend those are all my own knowledge. So, yes, good. So I'm gonna talk about three peers. Each peer, I want to understand whether you feel it's a tension or a synergy of this peer, two elements in a peer. The first one, we really want to understand because the title is the value creation. So I want to understand how do you think the ESG and the financial performance, the misalignment or alignment, is tension or synergy? That's the first thing. And second is within ESG, when we go into ESG, whether there's some totally alignment or synergy between E and S, or you need to make some trade-off. Right? The environmental and social side. For example, if you really want a healthy building, you have the ventilation. You have high ventilation, you consume more electricity. Or you do affordable housing, then you need to control the cost. Then you cannot do really this very, very good like environmental standard. That's a tension, or you can really make them work together. The third one is further into environment, E. And do you think physical risks or transition risks, right? Because you talk about SEC, and physical risk is like today, extreme heat, or hurricane, whatever. And transition, basically these regulations, sticks, and all the decarbonization things. How do you think these two? I'm gonna start from the first one, and because that's the biggest question to avoid propaganda problem. So that's a ESG and the financial performance, whether you see this tension or they see opportunity. Start from you, Jennifer.
Oh, for me. I mean, I think it's an opportunity, obviously. I think that, we work with clients across types of real estate, across geographies. And our clients, yes, we'll talk about regulations, and now there's so much more focus on their activities because of the ESG regulatory landscape. But many of our clients, and certainly the examples of the folks on stage as well, have been doing these activities for a long time, right? They haven't been doing them, again, just for propaganda, right? No company's gonna, just fund these activities, because it's a nice thing to do, right? There has to be some sort of return. There has to be some sort of reason. And really, with many of our clients, clients, they've been having questions from their investors about what they're doing in this space, and investors being concerned about the long-term risk in their portfolio for many years, right? I was answering questions from investors when I was at Prologis, more than a decade ago, when I was at CBRE a few years ago, right? So sustainability folks at these organizations are talking directly to investors. And it's funny, I was just at one of my clients in New York last week, and we had executives from the management team in the room with us, and they said, yeah, we understand we need to be doing these things. We're doing, this climate risk assessment because we know we need, more substantive things to disclose because of these regulations. But, you say that our investors care, they're going to care more, but, we're not having these conversations with our investor. And the chief sustainability officer said, that's because I'm spending hours talking to them, right? They feel satisfied in what we're doing because I'm already telling them we're doing all of these things. And so it's not that, the executive team maybe hasn't been kind of seeing it directly from the conversations with investors, but it's not that nobody's talking to the investors. The sustainability team has been talking to the investors. So I absolutely think that, and again, the companies that recognize that these things are important to their stakeholders are the ones that have been, getting out in front of the issues. And so I think that, they are seeing advantages to doing it. They're not doing it for propaganda purposes. I don't think that, we'd all be up here talking about sustainability and have these careers in sustainability that people have been funding our activities for this long if it was purely a marketing ploy.
Okay, great. So Sunita, we talked so much in our own company, and we need to, sustainable investment team, we need to convince the investment team and asset management team to really consider this. What do you think?
So I think a few things before getting into, I guess, the how, maybe a little bit about like the why. We talk about this struggle, you talk about, performance versus sustainability, how can you achieve both? So for us, the bottom line is the bottom line. We have to generate minimum returns for the pensioners. There's no compromise. But how can you do good or do better and still generate the right level of return? And I think if you take a few examples and you think about strategy, or you think about the customer, the end user, who's really driving the strategy? Are you responding to the market? Are you responding to the needs of people and how they use real estate, where they live, where they work? The whole, debate on the flight to quality and the return to office. So, we do believe, and I think I don't know if you said it. You said sustainability is the differentiator. What's its cost of doing nothing? If you have to ask yourself that. So, if you do nothing, and you just, don't believe, we don't have the conviction, it's not worth it, you will be left behind, because the reality is your assets will become obsolete and the value will decrease. And that's, the number one thing that we try to explain to the teams in terms of how are these concepts or, levers embedded into an underwriting and how we look at an asset. So for sure, the risk evaluation is a non-negotiable. We are going to evaluate everything from a risk standpoint. And then the value creation piece is, you mentioned Siqi healthy buildings concept, and I know MIT has this great study, I'm sure everybody knows about it, in terms of warranting higher rents if you have a healthy building, if you think about health, wellness, amenities, those type of things. If you're bringing that into a space, you're already creating that value and that engagement for your tenants. And I'm giving an example of an office tenant, but the reality is, this is their reality. It's the same reality we live every day. Do you want to work in a space that's got poor air quality, bad lighting? I don't want to be in a space where I don't feel good. And I did work in one for many, many years. So, it's all of those things put together and saying, well, are you going to ignore it, or are you going to do something about it and the cost? So we have developed some tools to try to simulate and project what that looks like. So the cost of investing into the green CapEx, we call it, or the cost of doing nothing. And in the long term, you'll see that your value will get obviously impacted in a negative way. But also going back to, when you work at a company and maybe you've been there a really long time, or you're interviewing someone and they come in and you meet them, the resume's great, and they come in through the door and you're like, okay, is this person gonna fit That whole, do you fit in? Do you fit into the culture? The reality is you have to ask yourself, do you still fit? Because if your values are not aligned with that of the organization and you are representing the company in whether a board or a committee and you're not executing your duties, embodying those values, that's a risk for the company as well. So, again, responsibility of bringing people along. We do believe that we look at it in terms of they're one and the same. They're not separate and apart. It's not ESG and returns. That's not how it works. But yes, you do need to generate the right level of return. So just this morning, we were looking at an investment, and it was another strategy I'll talk about, but it was a building it needs to retrofit, it needs a lot of work. And the conversation was, well, are we going to convert the building? Are we going to bring it from brown to green? What are the things that we can add? What's the long-term value? And everyone's questioning the return, but the return is there, and it will be there. So it depends on, obviously, everyone's different. There's different nuances, but at the end of the day, you should be able to, don't quote me on this because it's not my quote, but if you've seen the movie Air, and I said it to some girls last night, the movie about Nike and Michael Jordan, at the end, I think the CEO had these commandments, and his last one was, if you do good, money should be damn near printable. So I think that's what it said. It's not my quote. But you want people to want to be in your buildings. So how are you responding to that?
Wonderful. So Anna, Veris is a REIT. For REITs, it's listed, and the stock price is very important. And also, you are doing this investment on the interest of your shareholders. Mm-hmm. And then, what do you think? This compromise or not? And what do you think?
It's actually pretty easy. ESG and sustainability is good for business and bottom line, period. And I find it crazy that we still talk about it. That the other misconception I think that is out there is that it's expensive. But there's so many measures you can invest in your buildings that are not crazy expensive. Think about LED lighting, maybe smart thermostats. There's loads of incentives available out there to offset pretty large chunks of those costs. And things like LED lighting, the payback period is probably 18 months, maybe less, depending on the project. Like, how many CapEx projects in the buildings do you invest in that have way longer investment periods? And it would be a no-brainer for the teams. But it feels sometimes like once you put an ESG tag on it, it becomes suddenly something we have to justify way more. But it's just good for business. Not only does it pay back quicker, it reduces your energy bills for your residents. It makes the building maybe healthier, more attractive. There's a lot of ancillary benefits. So I do think we need to just move away from this separation, as Sunita, you mentioned, of ESG and returns and investments, and just look at it as an integrated part of how we look at deals, the same way we integrate a lot of other departments and perspectives into doing deals and investing into opportunities. And I think there's the element, we talked about more like the investment from the company side, but there is also the demand from the end user, be it on the office side that you heard from Sunita about, or actually on the residential side. I think residential was later in the game in this respect, but in a post-COVID world, people really want to live in buildings that are healthy. Like about a year ago, we had this crazy smoke from the wildfires in Canada down here. And suddenly, every resident knew on their Apple phone how to track air quality and started asking questions. And us being able to point to well health and safety, to things we're doing in our building, became important. And there's a lot of other things like that. People want to control the climate in their units. They want to save their own energy bills with utility prices going higher and higher. And they want more. They are interested. They care more and more about this environment. We actually survey our residents on an annual basis and have found out that an overwhelming majority cares about the environment, but a lot of them doesn't know where to start, and we're trying to help them. But going back to your question, it's alignment. We're increasing the bottom line by investing into these things. We're reducing our utility costs. We can see it when we compare the growth of our utility expenses compared to our peers, how we're doing so much better over the longer term period. There's a lot of studies out there. But for whatever reason, we still have to keep having these conversations. And I think we should just once and for all say it's good for business and go on.
Can I just say one more thing, just because you made me think about something, and going back to behavior and the whole change. As human beings, we tend to push back what we don't understand. And the minute you can make it, digestible, it's understandable, it becomes a lot more clear. And I think that goes for whether you're sitting in the C-suite, at the board level, like it's top down, bottom up. That's the whole challenge at times, is people don't understand. When you don't understand, you push back. So anyways.
Okay, good. I already wrote down, if you don't understand, you push back. And
you better understand.
And also,
Takeaway from today, push
I
back.
found it's crazy that we are still debating this. I will use these quotes in my class. Okay, so next question. So I'm very happy that, Anna, you mentioned air pollution and the wildfire. It means this pollution-related climate risk is basically cross-boundary, right? You can also say that you can only make yourself good, but you also need to think about how to collaborate, because those externalities really cross-boundary. And then wastewater and air pollution can always flow to other places. And then let's move on to this second peer, E and S, environmental and social. So we already talked about healthy building a lot, that's S, but we can talk about from another example of the S, also got touched base on several times here in this meeting, in this conference, which is housing affordability. So I want to briefly mention, I did a research, I did a paper, which will be published soon. So we look at Massachusetts. We use the Massachusetts data, and we have these 300 municipalities in Massachusetts, and Massachusetts is very progressive, and they have very stringent energy codes, stretch code. And then many towns, they opt in to adopt this very, very stringent energy codes. Means when you build new construction, you must meet this very, very low energy intensity threshold. Otherwise, you cannot get the permit even to build. So, and then we use the data. We look at these early adopters, or those municipalities. They say, okay, we are going to do this. We are going to implement this very stringent energy codes, which is very good for the environment. And even you can use passive house for this. And then we look at the consequences in the housing market. And from the data we saw, housing price went up and housing supply went down. The new construction went down. Because it's very clear to understand we have incremental cost. And then the builders will say, okay, it's too hard to build in this town. We are going to go to other towns. So then that town will suffer some shortage of the housing supply. And then that's so we can see this trade-off, or the tension between the affordability and the environment. Then the housing price went up also because people's willingness to pay for green building. That's a good thing, right? So we found that among all these price premium, 60% can be explained by the higher energy efficiency, and people, they are willing to pay. Households, they are willing to pay for that. That's good because they can save the energy cost for the future. But the other 40%, that's a pure effect because of the reduced housing supply. So which should be fixed, be addressed by the policymakers. They should not be so strict on the zoning, and they should give some incentives, carrots to the builders to offset this effect, so that the household they don't need to pay a much higher price, overpay for these energy efficiency green buildings. So that's my research example, and this tension really exists. But I want to understand from all three of you quickly that did you see any tension between E and S, or say, okay, we can do both, even G for the governance, but let's focus on E and S, and how you are thinking about this relationship with these two. And I know Anna and Sunita, when we communicate beforehand, I know that you always put effort on the S side, and I want to learn from you, and then finally, Jennifer.
So from the social component, I think we look at it from two different viewpoints. So there's the corporate social responsibility that we have in terms of who we are, how we operate, our employees, the spaces that we create for our employees. So that's definitely, the culture, all of that. And that's really, I think, a key part of the S, because at the end of the day, you could have the best strategy, you can have all the capital in the world, but if you don't have the right people in the right seat with the right mindset and the right empowerment, you will not execute. So that is fundamental to any strategy. So I think, the corporate side of things, again, the culture of inclusion and really living that and walking that talk is important for us. On the investment side of the business, I'd say that we definitely accelerated our strategies in terms of social impact, and affordable housing does form part of that. It's not easy. There is a part of our portfolio, our residential portfolio, that is today affordable, but it is not an easy solution. This is a bigger, I'd say, issue, and it has, there are local solutions. It's not a one-size-fits-all or the same recipe in every part of the world. We're invested around the world. What affordable housing means in Brazil is not exactly what it means in New York City. So those things, those local solutions is really what we're trying to figure out. And obviously, trying to figure out the best solution in our own backyard in Quebec is very important for us. And, are those solutions partnerships with different levels of government? Are they PPP type of structures where there's a public-private partnership? Let's come up with a solution because we're not going to leave money on the table. We can't. That's not, again, it's not a compromise situation. We can find the solution, but it's more than one person, more than one stakeholder. And there's different programs. I know there's a lot of programs in the U.S. that focus on affordable housing. There's the Section 8 program. I think there's, we do have a lot of, again, portion of our portfolio, I don't say a lot, actually a significant portion of the portfolio, the resi portfolio is affordable. But we did develop an actual strategy around this now. So that's part of the S that we're still working on. But again, not an easy solution. And then going back to there's also a DEI component on the investment side. So when we look at who we invest with, I know with the case, there's a large percentage of the investments not solely in real estate, but there is a requirement of diversity on the board when they invest the money within these companies. But we too have taken a bit of an initiative in terms of our partnerships. We've signed on to Diversity in Action, which is an initiative put on by the Institutional Limited Partners Association. And it just encourages best practices in terms of DEI. And we wrote to 70 of our partners and asked them to come join us. A lot of them are on their way. Some of them have signed up, and we'll say, today maybe it's a nice to have, tomorrow it'll be a must have. So I think those are the type of things. Again, we already talked about health and wellness, but we are trying to develop that methodology because the S is the big, how do you measure this? How can you measure in real, quantifiable way the social impact? I think you can, and going back to your customer, your end user, are we helping driving engagement, maintaining strong retention stats for our tenants? I think that also helps drive value. So those are some of the S components, Siqi.
Great. Anna, so as a multifamily, as your major products, the affordability should be very important.
Yeah, we're in a very Class A space. So even though we have some affordable housing, I think we approach the SPs slightly differently. And that's really on making sure that we're well integrated and really investing in the communities around us. And that could be different forms. It could be a real investment. When we developed our last building, House 25, we built a school that we gave to the city as part of the project. So now there's a public school adjacent to the building that serves the broader community of Jersey City. We've developed parks in the past, different types of infrastructure, et cetera. And then beyond that, I think it's really more the day-to-day engagement with the communities around us. That could be philanthropy. It could be just working really with the local communities, making sure our residents are well informed about the places they live in, working with local businesses. Sunita, what do you say about D&I, really going beyond our employees and into the communities, into our vendors, our suppliers, trying to encourage us to work with more diverse suppliers. We've increased the spend with minority and women-owned businesses by 25% last year, for example. So really taking steps to encourage the S in the broader communities to the extent we cannot do it in our buildings directly.
Wonderful. So Jennifer, I will switch topic because we run almost short of time. We discussed E and S. Now I'm going to go into E and ask you the question because you are expert on this, and the physical risk versus transition risks. And because you are working with many clients, and is there more of the focus on the physical risks or more on the transition risks?
Yeah, absolutely. And I'll take 30 seconds maybe to address your last question really briefly. Many of the regulations that are happening here in the US related to ESG and climate are focused on the environmental side of things. But for those of our clients that are subject to the Corporate Sustainability Reporting Directive in the European Union, they will be required to disclose on E and S and G matters for the organization. And so again, that's something that's happening in the EU, and it certainly would recognize that the S and the G are something that are very important and are continuing to infiltrate the regulatory landscape as well. But when it comes to the physical versus transition risk, I think obviously our real estate clients have been focused on physical risk for a long time, right? They have physical assets, right? They understand, they've been incorporating resilience aspects to those properties for a very long time. I think the one issue related to physical risk that our clients are starting to consider much more deeply now is insurance and the availability and affordability of insurance as it relates to those physical risks. So that certainly is top of mind for our clients. On the transition risk side, though, I think that's the side of things that hasn't gotten as much attention until relatively recently. And when we talk about transition risk, we're really looking at those risks of the world moving to more of a low carbon economy. So changing customer, tenant, resident preferences, increased risk of regulations, again, where the organization operates, changes in technology, changes in perhaps exposure to litigation, for example. So all of these things that could be risk to an organization because the world is moving towards a low carbon economy. So our clients are really thinking about the costs of decarbonizing their buildings, the costs of the grid decarbonizing, and how that's going to be passed along to them in terms of their utility expenses. Again, these new regulations, for example, and really incorporating these things into their existing enterprise risk management programs, I think is still relatively new for many of our clients. Again, physical risk, certainly, obviously, real estate firms well aware of what's happening in the physical space, but these transition risks are something that are of increasing focus.
If I may, I just think, the transition risk Jennifer just mentioned, they're also a huge opportunity for businesses. Technology, changing customer demand, even to be fair, some of the regulatory environments, if you're well prepared and you have a more resilient business, that means you'll be ahead of the curve to not just mitigate these risks, but really differentiate yourself and attract customers, grow your bottom line, and generate better returns. So I think it's important that businesses look at those from both sides and not just as something negative, but really see where could that be an opportunity for the business from a long-term perspective.
Great. Okay, so now I'm going to give some time to the floor for the audience to ask questions. Just now, we already talked about three peers: ESG versus financial performance, and E versus S, and physical risk versus transition risks. I took a lot of notes, and I'm going to teach next semester. And then, any questions from the audience?
From an academic standpoint, I'm somewhat curious about this debate because on the one side, if a market is efficient, we should do everything that is already profitable right off the bat and incorporate it in the prices. If there are future expectations, this is maybe harder to do. So one thing that we could do in real estate is look at the price developments of listed real estate firms that are increasing their sustainable performance to price these expectations on future price movements, because investors will want to value these changes in the value of the asset before they're being sold already right now in the current stock prices. So by comparing the current level of exposure versus the change in stock price when new investments are being made by REITs, you can potentially extrapolate how much money specific type of investments will be making. Thank you.
Okay, this is not a question, right? So this is
Can I address that, Siqi?
future research direction. Yes, but Sunita wants to
I think
address
you
it.
actually, I didn't really get to talk about it much, but you hit the nail on the head in terms of the pricing component. We've developed, we've modeled something, we call it the green IRR internally, and we are modeling pricing the carbon risk within the asset. So whether that's, it's stranded already today, and the cost of bringing it from brown to green, as we call it, what that would look like. and the cost of doing nothing. So we've done that. We've started to price that within our modeling. Our investment teams are doing the same. So the risk of basically going back to the risk of doing nothing, what would happen in the long term if your asset didn't get that injection of green capital. So that's something that we're also trying to roll that out within the market and within the industry. We talk about a lot. Siqi's working with us on basically our whole portfolio, our direct investment portfolio of, taking all the assets that we know today are stranded or will be stranded at a certain point. What will be the CapEx required to inject? What will the return look like? There may be a short-term negative impact, but in the longer run, it's a better play for the asset. So we're also, working within different organizations in real estate. So we meet often with groups like ULI, RealPAC. Obviously, we're here with MIT. So I think you hit the nail on the head, is how we're pricing things. And the reality is, going back to, we can't do it alone. The market needs a shift. And, looking at the Altises of the world and how properties are valued, like, are they giving a value? Like, insurance is talking about the risks from a physical standpoint, but, are we really looking at it the right way? And do we have the right lens on that financial modeling? So I think more to come on that.
Yes, I can testify because I spent so much time on the green IRR methodology, and Ivanhoé Cambridge has like 1,000 buildings all over the world. So we need to figure out for the portfolio level how to quantify those risks and how to quantify this return. Okay, we have a question here.
Is this on? I'd love to kind of hear your perspective on how to engage stakeholders within your organization. I feel like sometimes I speak to head of ESGs or head of sustainability and they have the right vision. And then, I get on the call with a CEO or someone else within the firm, especially asset managers who are not as well educated on the subject matter or are more hesitant to the conversation. So in your positions, kind of how are you engaging your internal team, not external, to kind of get on the bandwagon?
I think it's the education piece is what you mentioned, and having those conversations and explaining the tangible benefit of the investments to the bottom line. Because often to the asset management operations or other teams, investments, they just never use that as a lens to integrate it into their decision making. So they would not necessarily know that that's something they should look at, or that's actually another lever that's available to them to reduce expenses or grow revenue, et cetera. So I think it's education, it's explaining it in the way they understand it, which is often numbers. And then just really, I think for us, it's really ESG being integrated into the business. It's non-negotiable, that's what we do. And then I think throughout the organization, you get better engagement and get people at least willing to learn more, and the conversations are a bit easier.
We've done the same, but we've developed a whole training program internally. So developing people's competencies and reflexes to really understand the why, the what, the how. Again, demystifying what it's all about, because it's intimidating. You could be sitting in front of a sustainability officer and they're talking to you about all these things, and the asset manager's like, I really don't know how this is going to generate the return. Show me, right? Show me the money. But I think that's one component. So going back to changing behaviors, we've also, for many years now, have tied our comp programs to strategic objectives that are, that capture the entire organization. So everybody is going towards the same goals to get those objectives, to tie it to compensation. So that's another stick, carrot, whatever you want to call it. I mean, it's not a stick, maybe it's a carrot. But, there's different tools to do that. And I think for you, in terms of, who your audience is, and I briefly mentioned it to you yesterday, I think it's figuring out who they are and what their triggers are. And it could come from anywhere. Like, literally, learning things about people will give you ideas of what will impact them, because your intentions are good, but the impact is not understood. So you'll be coming in saying, look, I've got a great solar solution. I think you should check it out. It'll help, with your returns of your asset. If they're not a believer, then you've got to figure out how to get them there.
Good. So for this question, Jennifer, you have many observations because you have different clients. Do you have some observation?
Yeah, certainly when we're working with our clients, we really do try to engage the executive teams where it makes sense. So when we're doing a climate risk assessment for a client, for example, we're not just talking to the sustainability team. We're not just talking to individual functions. We're really trying to talk to the executive team and understand what their perspectives are. And really that education piece is so important, right? They don't speak this language a lot of the time. So really trying to engage that team in the process. But I think, Sunita, you had it, you hit it on the head. What is it that those stakeholders care about? Which stakeholders, do they care about? What are the topics that matter most to them? So a lot of times when I'm talking to executive teams, right, they want to know what the tenants want. They want to know what the investors want, right? And so being able to come with some of those proof points, some of those examples that are relevant to their organization, to their subsector of real estate, really can help open the door to those conversations.
Wonderful. We only have like 30 seconds left, but a quick question.
I'll be really fast. Scope 3, is it still part of the conversation? I saw Scope 1 and Scope 2 mentioned, but is Scope 3 actively being discussed or too hard to measure?
Yeah, so for Scope 3 emissions, if you do business in the state of California and your overall total revenues for the organization are at least $1 billion plus annually, you will be required to disclose Scope 3 emissions to the state of California. If you're subject to the Corporate Sustainability Reporting Directive in the EU, you'll be required to disclose Scope 3 emissions. So just because Scope 3 was taken out of the SEC's rule on climate disclosure does not mean it's not a part of the conversation.
Yeah, very clear. And and I will teach that in the class. And finally, yes, it's time. Time is up. Just want to conclude. Thank you so much for all three of you. And just want to mention that you need talents for your companies, sustainability talents. We have the MIT Center for Real Estate. We have our sustainable real estate class in our curriculum. And all students have to take my class. And I have all the knowledge here I will teach. And please hire our students. Thank you. Thank you all.
Thank you.
Thank you. Thank you. That was great. That was great. Thank you.
Thank you so much.
That was great.
Yeah, that was super fun.